What's up everyone, it's Caddy with MoneyVest. So in this video, I wanted to cover one stock. This is absolutely a no-brainer for me, and given how overbought the market is, given how technically we have rallied quite a bit since October, and given how valuations are a little bit of a concern, this is one stock that I bought towards the end of October, and I'm actually planning on adding more shares of this company to make it a bigger, more sizable position in the portfolio over the long term, as I do believe there's a lot of potential here, and not to mention the opportunity with increasing yield to cost is tremendous given how much it is already down from its all-time highs. So if you haven't guessed already, we are going to be talking about Realty Income Corporation. I want to lay out the entire investment thesis for me personally and kind of go over some of the reasons as to why I believe the stock is still fairly to somewhat undervalued, you could argue. As always, if you enjoy this video, find it helpful, make sure that you drop a like and don't forget to subscribe to the channel. I would really appreciate it. And link to our Discord and Patreon is going to be down below if you want to join, of course, be a part of our MoneyVest community. You do get access to a lot of members-only private videos, access to all the Excel spreadsheets, intrinsic value spreadsheets, S&P 500 valuation, volatility cheat sheet, everything's going to be included, as well as the access to Discord with over 20 plus channels, options trading, alerts, trade ideas, everything's going to be included as well. Now, this right here was the alert I sent out back on October 31st. Picking up over 200 shares of Realty Income Corp, ticker symbol O, at $47.35. And like I said, I plan to buy on more shares over time because the yield at those prices was over 6.5%. So I'm actually very, very happy with that purchase because 6.5% is actually a very, very good yield on an annual basis. And guess what? If the yield continues to increase, in other words, if the dividends continue to grow for the company, which I do believe it's going to happen because this is literally a monthly Realty Income is like a monthly dividend company, and they have been a dividend aristocrat of raising dividends every single year, then it's possible that my yield to cost increases eventually to over 8% or 10%, which would be absolutely phenomenal. I would be very excited to have that type of yield to cost with this company. So let's dive right into the portfolio snapshot. They've got over 13,250 commercial properties, and triple net leases is what they have, and over 98% occupancy of their portfolio, right? So they do focus very much on some of the more defensive companies, right? The likes of Walgreens and CVS and Home Depot and Costco and a lot of these companies, and that's what the client base is all about. And 85 separate industries with over 1,300 different clients. And these right here are going to be some of the companies. Again, Walgreens, Dollar General, Dollar Tree, 7-Eleven. We've got FedEx. We've got a lot of the other sort of restaurants as well, like BJ's is there. We got Tractor Supply, Tesco, LA Fitness. We got CVS Pharmacy, like I said, Walmart, and Sam's Club. So a lot of these, like even Red Lobster's part of their portfolio. So a lot of these companies are always going to be there, right? This is not something that can be easily replaced. People still need to go to CVS. People still need to go to Walgreens. People still need to go to Dollar Tree, Dollar General, Walmart, Sam's Clubs, FedEx, all these different places. It's a very, very solid portfolio of companies. And in my opinion, one of the ways that I can actually take advantage and have exposure in the real estate market over in the US on the commercial side. Now, when it comes to commercial real estate, I've kind of stayed away from office spaces more specifically because it's in a very, very distressed sort of environment right now, given that everybody's mostly working from home. And we have learned from the pandemic that most people can work from home. And as a result, the companies don't need to spend a lot on these types of leases. And a lot of the office spaces are empty, and for those reasons, the lenders have kind of been in a very, very tough situation where the borrowers are defaulting and they can't even, sell those properties for a profit because the values have dropped significantly because of the lower demand. So that's why Realty Income Corp, in my opinion, in commercial real estate is one of the better propositions, considering that their portfolio is made up of actual companies that people need to actually physically go in to buy the products and services that they need. So this right here are the top 10 industries that they operate in. And again, we've done some extensive analysis on this company before, and this is just kind of me going over it again. Over 98.8% occupancy rate. You can see how consistent it has been. In 2008, 2009, they kind of dipped a little bit. You can see that a little bit of a dip, but still well over 95, 97%. It's always been very, very strong. And this is the annualized dividends, which they have consistently grown every single year since 1994. And again, dividend increases very, very consistent for the company as well. Now, when it comes to rental revenue, from $750 million to over $3.8 billion in rental revenue. And operating income has also gone from $377 million to over $1.5 billion for the company as well. Net income has also tremendously grown from $250,000 to almost $900 million. But it's not really the bottom line profitability that matters, but what matters is the funds from operations, or in other words, the FFO. That's really what matters for any type of REIT that you're looking at. And you'll note that the funds from operations have gone from $462 million to over $2.7 billion. That's the FFO. That's the funds from operations, because REITs are also required by law to pay up to 90% of their actual profitability out as dividends for shareholders, and that's why the dividend yield for Realty Income Corp, if you come over, is a little bit over 5.89%, right? So almost 6%. Back when it was in the $40 range, it was trading as low as $44, $45. It was well over 6%, 6.5% at those levels. And we are still like oversold right now. Like if you take a look at the technicals, we'll come back to this, but we are still oversold. We're still really, really low from a technical analysis standpoint, which I'll come back to in just a minute. And this right here is the valuation. And for REITs, I think it's irrelevant to look at the price to earnings, because like I said, profitability is not really what we focus on when it comes to Realty Income Corp, because it's a real estate investment trust. What we look at is these metrics over here, which is price to average funds from operations and price to funds from operations on a trailing and on a forward basis. And right now it's trading at 12 to 13 times, which is actually quite reasonable for the company, because it's kind of in line with the sector median. And the reason for the drop for Realty Income Corp, as you can see that it's been selling off quite aggressively, is because of the acquisition of Spirit Realty as well. So they're going to be buying Spirit Realty for $9.3 billion, which the market did not like that number. And the transaction's expected to close towards the first quarter of next year. And this is going to be a 2.5% increase in the company's annualized adjusted funds from operations per share. And the reason for this acquisition is because they want to expand their portfolio of properties, and they also want to take on maybe a little bit more risk. It's not really sort of like a super high risk business to begin with, because we're looking at $9.4 billion in real estate investments, and they actually have a higher occupancy rate compared to Realty Income Corp. And they've got 338 tenants, so it's obviously a much smaller company, but they've got almost 100% occupancy rate. And this right here is the portfolio diversity. So if you come over to their portfolio, you'll notice headquartered in Dallas, Texas, Spirit Realty is a premier net lease REIT, investing primarily in single-tenant, operationally essential real estate assets, which are subject to long-term leases. As of September 30th, 2023, their portfolio comprised of 2,037 owned properties with an aggregate leasable area of 61.6 million square footage across 49 states and 37 industries. So their portfolio actually kind of resonates well with what Realty Income Corp does, right? So if for example, like Vici Properties, which is very much in casino and gaming, was buying Spirit Realty, it would not have been a good fit, because they are completely different industries that they operate in, right? So if you come down, you'll notice Lifetime Fitness, we've got At Home, we got BJ's Wholesale, we got Dave & Buster's, we got Churches, we got Dollar Tree, Circle K, the Home Depot. A lot of these are very good fit with what portfolio allocation Realty Income Corp has, right? So it's a good fit, basically, from an acquisition standpoint. The markets obviously did not like that number, and as a result, they sold off, from a price action standpoint. But now they're starting to bounce back higher, considering how oversold we are, and basically the dust has settled at this point. So if you look at the technical analysis, I mean, we've got a very strong support here for Realty Income Corp. So this right here, the green area, in my opinion, is a very good area of support as we have bounced off of that level in 2018. This was also the pandemic low, and this is exactly where we're bouncing off of right now as well. And both, like all three times, you'll notice the RSI, the MACD, was also very, very oversold. So there is potential, in my opinion, for us to see a little bit of that recovery back up to maybe over $60 per share. But this is mostly going to be a long-term position for me. So if we come over to Realty Income Corp, right, and if we take into account not the net income, but the funds from operations, right? So if you come back here and take a look at FFO, we're looking at trailing 12 months, $2.77 billion, right? So let's just assume 2.75, right? So 2750 is what I'm going to plug in. And let's just assume a simple growth rate in the actual funds from operations of 6%. 6% growth rate, and give them like a 14 times expected P multiple, 6% discount rate because the company has an insane dividend yield of over almost 6%, 10% margin of safety, and I believe the share count has also been going down. No, actually it's been increasing a little bit. So more recently they have seen shares outstanding going up. So let's just assume, let's say 2% share dilution. We're looking at a $43, $44 in intrinsic value. This is exactly where the price was just last month, right? So low for October was $45 per share. So we were literally at those levels before pushing back up to over 52. Now, if we assume for slightly different numbers, so let's say that they can actually grow after the acquisition, their funds from operations by about 8%, and the expected P multiple right now it's at 13, 14. So again, if you come over to valuation, we're looking at 13 to 14 times. Let's assume that they're going to be at 15 times, a little bit of that multiple expansion. Then we're looking at $51, and then only 2% it needs to come down to be trading at its intrinsic value. So the bottom line is that this stock does offer, in my opinion at least, a good risk-reward trade-off from a dividend perspective. And this right here is going to be that sensitivity grid. And I would be more than happy to pick up more shares. And then if also expect as dividend yields continue to expand or get better and dividend increases, then that yield to cost to also get better over time, because when you're investing in dividend stocks, it's not really so much the dividend yield, but it's the yield relative to your cost basis is what really matters, right? The yield that we see is the dividend versus the market price, but at the end of the day, what really matters as dividend investors is the dividend relative to our cost basis. So to give you a simple example, is a dividend annually, if the company is paying, let's see, so let me just come down here. If you come over to dividends, let's say the dividend is just under $3 per share, and right now it's trading at 52.48. So you do the math, and that's going to come out to 5.89%. But if you had Realty Income Corp at, let's say, $30 per share, and they're paying $3, that's a 10% yield to cost for you, right? So it's much better, much higher than what the actual market dividend yield is. So with any dividend stock, the goal would always be to increase the yield to cost, okay? And of course, if the price rotates back up to over $70, $80 per share in the long term, and the yield continues to be at 3 to 4%, then I'm assuming that the dividend per share is going to increase, to a couple, $4, $5 per share, which obviously is going to increase the yield to cost over time as well. So that's the entire analysis. Let me know your thoughts down in the comment section below, but this is where we are in terms of that support. We've also got a pretty strong resistance sitting right over here. So that's going to be that area of resistance and that supply to also pay attention to for a Realty Income Corp. And like I said, it's a little bit of a range-bound pattern where it's just been trading sideways since 2015 in sort of like that consolidation pattern. But that next target and resistance is going to be all the way up to $70, $75 per share. So I hope you guys enjoyed this video. Found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord, Patreon is going to be down below. Access to Excel spreadsheets, members-only private videos, Discord access, everything's going to be included with a couple more spots left if you're interested in joining. As always, happy investing. I'll see you all in the next video.